Earnings per share, or EPS, is a vital metric used to assess a company's profitability. But what exactly is EPS? How is it calculated? And why is it so important for investors? In this video, we'll break down everything you need to know about EPS. What is EPS? EPS represents a company's net income divided by the number of outstanding shares. It tells investors how much profit is attributed to each share of stock. For example, if a company earns 1 million and has 500,000 shares, its EPS is $2. Basic versus diluted EPS. There are two types of EPS, basic and diluted. Basic EPS uses only the current shares, while diluted EPS factors in potential future shares, like stock options or convertible securities. Diluted EPS gives a more conservative view of profitability. EPS and stock valuation EPS is often used to calculate the price-to-earnings (PE) ratio. A high PE might suggest a stock is overvalued, while a low PE could indicate an undervalued stock. EPS helps investors determine if a stock is priced correctly relative to its earnings. The impact of stock dividends and splits. Stock dividends and splits can change the number of shares, which in turn affects EPS. A stock split increases the share count, reducing the EPS, but doesn't affect the company's actual value. EPS growth. EPS growth is key for investors. A company with consistently growing EPS is likely performing well and could have strong future potential. Investors look for this growth to gauge sustainability and profitability. EPS in investment decisions. Investors use EPS to compare companies, and it helps in making investment decisions. A higher EPS often leads to stock price appreciation, and consistent EPS growth can signal a stable company with a strong future. Limitations of EPS. However, EPS isn't perfect. Extraordinary items, accounting manipulations, or changes in share count can distort the true financial picture. That's why it's important to consider EPS alongside other metrics, like revenue and cash flow. Real-world examples. Let's take a look at real-world examples. Companies like Apple and Tesla show strong EPS growth, reflecting their profitability. Coca-Cola's stable EPS growth over decades demonstrates its consistent earnings, while Amazon's reinvestment strategy can make its EPS less impressive in the short term. To sum it up, EPS is a critical tool in understanding a company's profitability and growth. But remember, it's just one piece of the puzzle. For a full analysis, always consider EPS alongside other financial metrics. Like, subscribe, and comment with social media icons. If you found this video helpful, don't forget to like, subscribe, and leave a comment with any questions you may have about EPS. Thanks for watching.